CNBC-TV18, embarking on a quarter century of excellence.
Well, it's an all-time high week for the markets. The Nifty hit a new all-time high. The Bank Nifty, which has been the laggard, has hit a new all-time high. Mid-caps and small-caps, well, they need little by way of encouragement. They've been doing absolutely fantastically well. The election results over the weekend, of course, really powered this fresh leg up move. Global cues have been very supportive as well, with Fed Chair Powell indicating that maybe this big global hiking cycle is behind us. What next? Is it too good to be true? And will this stay this good for the foreseeable future? Let's put this question to one of the foremost sort of minds in the Indian investment landscape. Naren is CIO at ICICI Pru Asset Management Company. Naren, great to have you with us here. Thank you very much for your time.
Nice to be here.
As I ended that by saying that too good to be true, but it is true. But how true, Naren, according to you?
No, we manage other people's money. We have a lot of old money. We have to get investors to invest today.
Right.
For all the people who have invested old money with us and we are managing, it's a
well.
fantastic situation.
Right.
What about the people who are investing today and we manage other people's money? That's the challenge, because when you're talking at all-time high, there are always challenges.
Right.
Because where does risk come from when everything is good is something we have always seen.
Right.
We never know.
Right.
And when you look at the macro of India, it looks very good. You have a situation where current account is comfortable, oil is coming down, globally interest rates have peaked. You have a situation where India is one of the highest growth countries in the world, and you have fair amount of political stability, so policy stability.
So where can risk? Sometimes good is just good, right?
Good is just good, but when good is good and good is not priced in, becomes very good.
So what you're saying that a lot of it is priced in?
Part of it is priced in.
Or getting priced in very quickly?
No, it is logical for the market to price in. So that is the challenge from an investor perspective. How much is priced in?
Right.
And that is the interesting aspect, and that is why we realize that the best way is asset allocation. And
I'll come to what to do in just a bit. But what to your mind? The state election results. There was some anxiety at the margin about what will happen in 24 and whether it'll be as strong. But these are remarkable results for the ruling party. What does it mean to your mind from an political economy perspective?
See, I think what it means is policy stability. And what it means is if you do macro in a proper way, if you look at the last 10 years, they have been very committed to fiscal deficits. They have handled current account deficits in a very systematic way. They have handled inflation in a very systematic way. I think what it shows is that if you manage to keep the macro under control, you have a situation where the people like it. Because we have seen many other countries, many other emerging markets, they have not handled macro in a nice way. And handling macro in a nice way is very important for the people. And all the countries where macro has not been handled in a nice way, they have suffered, the people have suffered. And that's a very, very interesting learning, because 10 years is a long period. Throughout this 10-year period, we have had very good macro. And this has been periods where oil has shot up, oil has come down, you have had global problems, you have had COVID, so many things. But macro has been handled very well.
The other leg is reforms.
Yes, absolutely. Reforms have happened subtly. So no one will realize GST has happened. So much of digitization has happened. If you look at the amount of income tax reform that has happened, which has resulted in a fantastic increase in income tax collection, no one talks about it. But you can see the rapid buoyancy at this point of time. So all these things, the kind of work that has happened in UPI and all these things is very quiet. And
the bet is that with this kind of mandate in the state elections, and maybe that gives, it basically shows you that Prime Minister Modi and the BJP are in top form to contest 2024, right? Which gives confidence that there will be continuity in all these areas, which you mentioned, the macros, and of course, added new reforms, etc. as well.
Yeah, what it means is no one will do something stupid on the macro side, because with good macro, not doing some stupid macro things, we have had a very, very good growth in per capita income over a decade. And that is what we have seen over a period of time.
The other leg, which I think is also turning and changing, is the global macro, which you and I have spoken about in the past, right?
Yeah.
Is that turned now? The big 500 basis point hiking cycle is behind us now. Can we say with any amount of certainty?
You know, the whole world looks only at interest rates and inflation, but there could be other problems.
I agree, but interest rates, by your own admissions, are also extremely important, right?
Yeah, it is important.
Policy cycles are very important for markets.
It is important, but you're not going to have 0% interest rates and quantitative easing
anytime soon.
Yeah, you're not going to have that.
No, but what's your view? Is the hiking cycle behind?
The hiking cycle is behind.
Okay,
but
but rates may stay higher for some time.
Yeah, rates may stay higher, and the only problem is not only interest rates.
Right.
I mean, there could be other problems as well. And that is something that the market is only looking at one thing now and saying, okay, interest rates have peaked.
Right.
There may be interest rate cuts.
Right.
But what about a weakening economy in many parts of the world?
Interest rates going down kind of eases the pressure and takes the spotlight away from many of these problems.
But will 5 become 2? It won't.
It
5
won't.
may become 4.
Right.
I don't think anyone is calling for 5 to become 2 at this point.
But would you agree broadly that compared to 6 months back or a year ago, as we enter 2024, things are looking much more benign in that sense?
Yes. I think the environment for foreigners to consider emerging markets to invest is definitely much more benign than 1 year back. Because I think the rate hiking cycle is over. When the rate hiking cycle is over, you don't worry about dollar going up. So therefore, people will obviously consider investing in emerging markets. So the entire macro cycle has certainly improved over the last 1 year.
And you've looked at macro cycles for the last 30 years. You've looked at sort of historical data. What does a sort of, a phase where dollar weakens and interest rates maybe will stay high but gradually taper off over the next 2 years or whatever, what does it mean? Does it mean inflow into emerging markets in a big way?
It could mean inflow into emerging markets, but for that China has to perform. But it's also inflow into gold in a big way. So if you look at the way gold has moved over the last 2 months, it shows that gold is also an asset class which will do pretty well. And we're seeing that in gold on a continuing basis in the recent past. So what all will do well is going to be a factor which will be interesting to see. And it's not going to be one way. When you're going to have a situation where economy weakens, whether you're going to have only EM getting flows or you're going to see a situation where for some periods of time equity markets also correct, because who would have thought that with 5% interest rates, US, those 7 stocks will do so well in US, that NASDAQ does so well. I don't think any of us predicted. I don't think, at least I predicted.
Many believe, Naren, that the next sort of turning point, next change in narrative will happen when US growth suddenly starts to be hit hard. Suddenly people wake up and say, well, finally we have to pay the price for rates being where they were and rates being held high. And then that's the next change in that sense. Do you think that will happen?
It should definitely slow down. But at that point of time, what happens to markets? Correct. It's a question that I'm not able to correctly judge. We at ICICI keep on thinking about it. But what we are very clear at that point of time is gold will do well.
Gold will do well. Okay. And that gets us to the asset allocation point, which we will get to in just a bit. But I want to just finish this point. So whereas we've discussed global, we've discussed local macros and local political landscape, where does it leave India? In a pretty good place overall, right?
India is in a fantastic place, except that Indian valuations are completely different from the rest of the world.
Right.
If you look at it, that valuation expansion has continuously happened.
Right.
That's all. But otherwise, if you look at it just from the point of view of outlook, I think there is nothing to say that there's any better country than India.
Right.
All the other countries have serious challenges in one form or the other, whereas India doesn't have those challenges.
Okay. So let's narrow it down. What's the big message? The consensus for some time has been, and you've been saying it as well, focus on large caps, don't focus on mid caps and small caps if you're putting fresh money to work.
Yes.
Is that the main message?
Yes, absolutely. And the other message is clearly that you can't predict the top of this market. Because the top of this market will be determined by how much foreign flows come in 2024. It can't be predicted by local flows because local flows have been very good over the last 2 years. They've taken markets to where they are without foreign flows. So markets can absorb a lot of foreign flows, and the markets can go up to the extent that foreign flows come in 2024. Almost everyone we speak to say that foreign flows are yet to start. So if they come in a big way, you can have a much bigger move, and that will be obviously more large capish, but how much they will be is something which people can't predict, because it depends on how the US economy shapes up, how US interest rate shapes up, and those kind of factors will play a role in determining how much foreign flows will come.
But again, to that point of mid caps and small caps, are you saying that if you put fresh money to work in mid caps and small caps, be prepared for below average returns over the next 3-4 years? Is that
there we have a simple framework. We call it the boom cycle. In a boom cycle, when people invest, you don't make big returns in the medium term. And that boom cycle has been clearly seen in mid caps, particularly in the last 6 months. And in that framework, we've always seen that if you invest in any boom cycle, whether it is IT in 2000, whether it is infra in 2007, whether it is small and mid cap in 2017, again now, you don't make money in the medium term. You will make money in the long term, but you won't make money in the medium term.
You know, one of the reasons which many have spoken about why mid caps and small caps are doing well is also because they represent sectors which are doing well. Manufacturing, industrials are represented in a much larger way in mid caps and small caps as opposed to, say, the Nifty index or the Sensex index. And that's where bulk of the action is happening, you would agree. I mean, what do you say to that?
That part of it is true, but then the valuations are already accounting for that at this point of time. So you pick any company today in the small and mid cap, I think the median PE has gone to 30 to 40. So when you have a median PE of 30, it means you're paying for 30 years of earnings. So then automatically it means that you're already paying for all the growth that is expected at this point of time. And we have seen these cycles. If you look at a cycle like 2006 to 13, that cycle was pretty bad for mid caps at this point of time. There was another cycle from 1995 to 2003. So we've always had these cycles, and in all these cycles also the same kind of arguments were made. But the fact is that these cycles do happen in small and mid cap investing, and people would like to believe that there are no cycles, but you've seen even in US the small cap cycle has been pretty vicious in the recent past. So for people to believe that you will have no cycles in such investing, then that is never the case. We always have these cycles.
We always have these cycles. So what is the thing to do for people who are watching for inflows into equity funds has been extremely strong. Inflow into equity markets has been very strong. New demat account openings have been through the roof. But where should sort of investors put money, fresh money in?
So I think, at all-time high, all-time caution is required. And, in the years of investing that I have seen, how do you practice more caution at the top? That's the toughest challenge.
But you're not calling this a top. We don't know if this is the top.
This is not the top.
Right.
All-time high is a period where you have to exercise more caution.
Right.
And the areas where people have to actually exercise more caution is not in mutual fund and hybrid. It is if you invest through derivatives, for example. If you invest in IPOs, for example, in sectors which you don't understand. These are the areas where people have to actually exercise more caution. And that is our learning from the past. And we always tell people, look at simple indicators like price to earnings, price to book, dividend yield, return on equity. If you're able to identify these things more clearly in a stock, you're in a safer company. Otherwise, you have to do much deeper work on that company to decide whether to invest or not to invest. So this is our learning from looking at more companies at different points.
No, but as a broad idea, what is the thing to do? I mean, even within mutual funds, do what? I mean, what kind of...
So that is very simple. We've been telling people invest in multi-asset. We've been saying this last year also in the same time. Because finally at this, our view is that you have to do unconstrained investing. So if you're able to invest in a multi-asset fund, you get all the asset classes. You get gold, you get silver, you get REIT, you get InvIT, you get debt, you get equity. Maybe a little bit more of equity. But that kind of a framework actually works best in this kind of a market where there's no asset class which can be deemed as cheap. And that's what we've been telling people continuously over the last 6 months. If you look at the way gold has moved, investors in multi-asset have benefited from that move. And that is what we've been telling people on a continuing basis. And that continues till one asset class becomes very cheap. And when that will happen is not, we don't know. It may not happen in 2024.
Right, no, absolutely, got that. We'll take a quick commercial break here. You heard from Naren what he'd like to do, top down, what his views are. We'll come back after the break and we'll dive into sectors and themes that he'd like to bet on from here out. Stay with us.
CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. We are sitting down with S. Naren of ICICI Pru AMC. You heard the top-down view. His, of course, view is that mega caps are to be preferred. Small caps and mid caps, the run has been fantastic and you should expect moderate returns going forward. Let's dive into some of the sectors that Naren would like to bet on from here on. Naren, in terms of sectors, what are the big ideas you have?
See, basically, many of the sectors which we actually were positive on 3 years back, which were non-consensus, they all have played out. So we were positive on telecom, we were positive on power, we were positive on metals at that point of time. Metals, of course, played out very quickly. And those sectors have played out. So now we are actually struggling, which is the next set of sectors to play out at this point of time. Auto, for example.
Auto has played out.
Played out. All those have played out. So now we are struggling actually, which is the next set of sectors which actually will play out. That is why when we did whatever work we could do, what we realized was it is on capitalizations that it was clearer. So if you look at any sector, you take even a sector like banking and financial services, the top banks haven't done well. Whereas the bottom small banks, many of them small financial services companies, they've done extremely well. And if you take IT, the top IT companies have done badly. The small IT companies have done extremely well. So what we realized over a period of time at this point of time is that it is the mega caps in each sector which has done extremely badly compared to the smaller companies in the same sector.
Which have done well.
So this is what we realized. If you look sectorally, there were sectors which we used to be very negative on, like FMCG, for example. Those sectors have done extremely badly at this point of time. That no longer it makes sense for us to be so negative on these sectors. But the irony in these sectors is these valuations have not corrected. It is only that the other sector valuations have gone up substantially. So maybe on a relative basis, this sector has become cheaper, but not on an absolute basis.
Absolutely.
See, what we find is some of the conglomerate mega caps, they've all become much cheaper because they've underperformed significantly in the last 3 years. So it has become much more of a relative game to say this is better than an absolute game, because when you have had such a whipsaw big move in the last 3 years, and this is what we used to tell 3 years back, that there were so many cheap sectors at that point of time, and with lot of potential to put money. But those sectors, everything has played out. And that's why when I tell people that in the last 6 months we have told, even before this big move, that today the long-term return story is more moderate. People say, no, it can't be moderate. After all, we have seen very big returns. But we tell them 10 years, you've had more than 20% return in small and mid-cap index. And you know what we've seen from the real estate story of 2002 to 2013, when you have this more than 20% return in more than a decade CAGR, actually people tend to think that it will go on forever. But it never goes on forever, and you have to prepare yourself for a more moderate return period. But it's so tough to convince people that you're in for a more moderate return period, and that is very tough, because every PE which I had seen in 2003 to 13, in 13 what the price to earnings was in ICICI we used to discuss, and today what we discuss, we give valuations which are much higher than what we used to give in 2013 in our company.
Coming back to sectors, I mean, as you said, there are no real bombed out sectors. Maybe small chemicals as a space, or maybe, but nothing very large which has come off substantially valuation-wise. So in that sense, it's relative, you're saying.
Yes, absolutely.
So you're forced to actually, maybe even FMCG that you said has not done well. You may not really like it very much, but it's just that it's not done very well.
We like the sectors.
Okay.
If you have a situation like, for example, we invested in many of our company funds, two-wheeler. What is the thesis? 2013 to 20 3, for 8 years they had negative growth. So we like the sector. But at least there the valuations had become really cheap in some of the companies. So it became very easy for us to buy. If you look at FMCG, the volume growth, we talk of India story, but what is the volume growth in the entire FMCG space? It is all very, very low.
Correct.
So it becomes very, very attractive to say that this kind of volume growth cannot happen in an India story. But the fact is that while the volume growth is very low, the valuations are not
They've
as
not
low.
corrected. They still remain high, but
But the volume growth can't remain like this. Then there is no India story.
Correct.
If in every FMCG sector you're going to have 2% volume growth.
Correct. Manufacturing, PLI, Make in India, are those themes that you're betting on?
I think those themes are very, very attractive. But for that, on a continuing basis, we should have low power cost. We should have low manpower cost, low land cost. We should have supportive infrastructure. All these things have to play out. But in manufacturing there, if you look at the EMS space, many of them are trading at 100 P. So with the value contrarian mindset that some of us in our team have, we find it very difficult to bet on such themes. And that's the challenge that we have.
So avoid what? Let's start there.
Avoiding is much easier. You avoid, you have to be careful in small cap investing. You have to be careful in derivative investing. You have to be careful
Global
in
facing
mid-cap
sectors is
investing.
something you were saying?
Yeah, you have to be careful in global facing sectors. You have to give lower valuations. These are the areas to be careful, if you ask me. I don't think there is anything which is thumping the table at this point of time. I mean, you're talking to me when we are managing other people's money at all-time high, and you're asking me for thumping the table ideas. It's not easy.
It's not easy. Absolutely. Let me just wind this up with sort of two things to watch out for. Not risks, really. I think one, you believe that, say, IT salaries are very important to track. They've not been growing, that is one.
Yes.
And the other thing, of course, is equity markets staying up, because, we talk about real estate, but many do believe, and I think you do as well, that the wealth created in equity markets has been responsible for this upcycle in real estate. So just talk about that.
So I think we have to recognize that what's happened in the last 3 years after COVID is equity has become a very, very big asset class for domestic investors. So if you look at it, people are less investing in other areas of financial savings. If you look at the net investment of net savings, net financial savings which is happening of people, it is much lower than before. People are leveraging much, much more. It's an area which worries us at this point of time. The equity market is not the area of worry, because people are giving good amount of money as SIPs to mutual funds. People are investing in NPS. All those things are happening. But we do worry about the fact that the leverage is increasing in the financial system among retail. And that's why the Reserve Bank recently increased the risk weightages on personal loan. I think it was a fantastic step on the part of the Reserve Bank to do it. So I believe that, that is an area of worry. Is it a stock market worry? It is not a stock market worry. But, we are believers that as long as everything is stable, like a macro, you manage to ensure that personal leverage is under control. Corporate leverage is in just great shape. If you look at the entire corporate sector at this point of time, it is not like 2010 to 20. If you look at real estate builders, they are in great shape. So all those problems of 2010 to 20, either with corporates or with real estate, doesn't exist. So the only area of worry right now is that we are hoping that retail is not leveraged. It's unlike 2010 to 20 where we never worried about retail leverage. And that's why the Reserve Bank has rightly taken all these steps at this point of time, and that's an area of worry. Is it a direct stock market worry? No. It is an indirect stock market worry.
Naren, we'll leave it there. Thank you so much for sitting down with us here at CNBC-TV18. Thank you very much
Thank
for your
you.
time.
Wish everyone a happy 2024.
Thank you.
CNBC-TV18, embarking on a quarter century of excellence.